Hi, and welcome back to the Intentional Wealth Update with Morton Brown Family Wealth. I'm Dennis Morton here with Katie Brown. Katie, how you doing?
Hi, Dennis. I'm doing very well. Thank you. How are you?
Good. We've got something fun to talk about today. These are the three charts that are going to help you make sense of the markets in any environment. Katie, why do we use these charts? Tell me what you think about this.
I love these charts because they are fantastic reminders. We can't predict. We're not going to be able to predict in any given year what asset class, what particular part of the market is going to just soar that year or which one's not going to. And it reminds us that all these things can be happening throughout the world and we can still make money along the way. The market can still grow and expand along the way. And it's okay when we have those occasional pullbacks, but the longer term trend historically has been positive.
Yeah, I feel like in these charts, if somebody said, Dennis, you're on a desert island with all of your clients and you get to take three charts with you, these are the three. And I don't know if it's paper or we get PowerPoint on this island, but it's fintech's coming a long way. So maybe we do get the charts. But I'd bring these three charts because the most frequent questions we get, I can probably answer with one of these charts. Is that fair to say?
That is very fair to say. That is very fair.
All right, so let's start off with the first chart here. We're going to pop this up. This is called the Callan chart, the Callan periodic table of investments. For all you reformed chemistry majors out there, it's going to look like the periodic table of elements, but this one answers the question, what's going to happen in the market next year? Here we go. Katie, what am I looking at?
A beautiful, colorful quilt with no pattern whatsoever.
None. So what this is you have a lot of investable assets, everything from US stocks to bonds to real estate, large, small, domestic, international, all the things that you would find in your diversified portfolio. And it ranks them by year in order of performance. So the top row is the top performer every year. The bottom row is the bottom performer. The question is, pick out the pattern.
There literally is none. There is none. And this is looking at the last 20 years. These actually roll back further and you still can't find a pattern in here. But I do think that there are some things that jump out to me on the chart that I find somewhat useful. One of them is, what is the most common bottom performer?
Yes, cash.
Cash. And in fact, if you look at this, cash is only in the top half 5 times out of the last 20 years. So 25% of the time, meaning 75% of the time, it is underperforming at least half of the asset classes out there. You get 2008s and you get the end of 2018, you get 2020, and you get 2022. Like those are the years when people are like, maybe I should just go to cash for a little while.
Yeah.
And there's risk in doing that because cash will, over the long term, it's going to underperform.
Right. That question, should I just go to cash and wait till it comes back?
Yeah.
It hasn't worked. It doesn't work. So that tells us what's a perennial bottom dweller, but we can also see what asset classes tend to be more volatile. So take a look at emerging markets, for example. That's the orange that you see up here in 2003 was the top performer. Same in 2005. Really for the better part of the first decade of this millennium, emerging markets were the place to be until they weren't, because they went from top to bottom to top to bottom to top. So we expect emerging markets, that's your China's, Brazil's, India's, South Africa's, you expect those to be more volatile because of the nature of their lesser developed economies. Another asset class, real estate, top to bottom. Here's the great financial crisis when real estate was at the bottom there, bounced back. And the same thing happens year to year. It's a volatile asset class. So when we invest in it, it helps to manage our expectations to say, well, we kind of expect it to do that.
You know what I find so interesting when talking about emerging markets and real estate? Because if we look at them both on here, to your point, it can be top to bottom. For real estate, in experiences that I've had in conversations, there's a much higher comfort level of investing in real estate than there is emerging markets.
Yes. Oh my gosh. Familiarity, right? Is it familiarity?
I understand what's all around me. I'm used to this thing here. And absolutely, it comes back, I think, to familiarity. A lot of people, they own their homes at the very least, even if they're not actively investing in real estate. So like, okay, I kind of get that. But it is fascinating how some asset classes, there's almost the fear factor, I think, holds some people back more than other asset classes, which could bring just as much volatility.
Yeah, totally true. And just one more thing on this slide here is that there's a line, I think it might be a Michael Kitces line, where he says, diversification means always having to say, I'm sorry. Meaning there's always going to be something at the bottom. You can't pick the things that are every year going to be at the top. You have to have the mix, because what was out of favor last year might be in favor next year. And you have to have that right blend of them.
Yeah. Yeah.
All right.
All right. This is one of my favorites. The next one.
Yeah. The next, what question do you think this answers?
I think the timing question, like, is now a good time to invest?
All right. So here's our next slide. All of the reasons not to invest over the last 30 years or so. So this goes all the way back to the early 90s. And what you see, this is a plot of the S&P 500. That's the line going up here. And then it might be a little small, but all these are little news events and reasons why you would definitely not want to put your money into the S&P 500 at any one of those points. And there's a lot of them. I mean, we're going back to the recession of 1990 all the way through September 11th and Brexit, and just you name it, geopolitical, economic, just catastrophic. All these things are on here. And yet, Katie, look at that rate of return.
It's massive.
Yeah.
It's now, and there are periods of time where it's not growing at the same pace, but those are also great periods of time to be investing into the market, so that when that market takes off, now you have more shares, you have more numbers of shares to grow at a greater pace. And we've talked about that before too. Even if market conditions are not ideal, there are still productive things that can be done during that time period. There are still some benefits to sticking with the plan and sticking with investing and growing over time.
And also, this is just the stock market. If we're talking about a diversified portfolio, if you're heading into retirement and you're sitting on some blend of stocks and bonds, that this is just the stock portion of it. You're going to have other things that act as ballast. But if you picked any one of these reasons to bail out of the stock market, it's going to impact your plan dramatically. And to your point, Katie, look at this period from 1999 all the way through the early 2010s, where the market was essentially flat. And if you're a 55 to 65-year-old retiree or pre-retiree, those were your accumulation years where you were buying on a massive decade-plus long dip.
Mm-hmm.
And you're putting money in every pay period.
Were you getting growth in other areas?
You were getting growth. We didn't put international up, did we? No. All those emerging markets. If you had emerging markets in that window, you were feeling pretty good about yourself, right? So there were other things out there to be had. Not yield back, for the last 10 years or so, but there were other things to be had.
Correct. Yes.
So I think this is that headline risk to say, oh my gosh, why would I invest when we know this is going to happen or this just happened? This kind of acts as a counterweight. There are ones that go all the way back to 1927, which are really kind of fun to see.
Yeah, they're fascinating.
All right, Katie, here's the last one. I think this one, the question that it answers is, the market's down 5% off its all-time highs. Are we going to collapse here? Is it going to keep going further? What's happening with this market? It's crazy. It's going down. However, isn't it just a normal year?
Yep.
Talk about this chart. What is this? We've used this in our quarterly market updates, and we love using this one. And this is actually updated through the end of August this year.
Yeah. Yeah. So this goes back to, 1979, 1980. So last 43 years, once again, looking at the S&P 500, and the gray bars show where the S&P 500 finished at the end of the year. And we can see more positive years than negative years. In fact, 32 out of the last 43 years were positive years. We haven't quite finished 2023 yet. So that's where it ended. The red dot, though, is the intra-year drawdown in the S&P 500. So the red dot is, at some point during each of these years, there were negative returns, 9%, 19%, 14, 8, 28, negative 20, like far beyond where the market actually finished the year in the vast majority of the cases. So it's that great reminder that we can have a really strong, good year, but at some point, something is going to give back, something's going to reset, and that's totally normal. And that's okay too. Sometimes we just need to kind of rinse out a little bit of risk and reset.
Yeah. All of us as investors have very short memories. It's hard to recall all this. It's kind of like being a parent. You kind of forget all the bad stuff. You just remember the good stuff most of the time. But look at what we went through in 2020, a negative 34 drop to finish up, was that 18? So that can happen in the course of a year. So for us to be down, I think at most we were down about 5% recently, maybe 7 or 8% earlier this year. Yeah, 8%. These are normal occurrences, and they're coming back to the original thesis. It's not a reason to bail on your plan.
Yes. Yeah. Yeah. These are great reminders, I think. As you mentioned, for just about anything that's happening, sometimes the market just gives a little bit back when it doesn't seem like there's a specific event that's causing it. There could be a lot of things kind of happening under the surface, and it just kind of cools off for a little while. But sometimes there are major events, and sometimes you just feel like there is no value in investing in whatever asset class. Those charts really touch on all of those various areas, and hopefully are really good reminders to stick to the plan, permission yourself to zoom out and say, okay, it's going to be okay.
Yes. I also like that each of these, I've seen variations of these throughout my career. So it's not sometimes, information, you read an article in the Wall Street Journal or pull a piece of financial news, it's information presented in a new way that's unfamiliar to you. That's hard to digest. I like that these look the same every time. You can pull them up and say, oh yeah, that's right. It looks the same as it did 3 years ago, 5 years ago, 10 years ago. There's something that's comforting and takes emotion out of things. So that's why we say, if you're looking for 3 charts to help kind of center you and ground you, check these out. We can share these out. If you like, reach out to us. We can send along just our distribution. We'll be talking about them more and more. We revisit them in our quarterly market updates. So please feel free to join us for that. Katie, any final thoughts for today?
No, I mean, keep coming to us with questions as you have questions, or as you have concerns, and one of the reasons obviously we wanted to pull these up is because we are having a bit of a pullback here in August, and we just really want to continue helping to build that context to say it is normal.
And please check out our podcast, Simply Why Podcast. It's a podcast about money and purpose, where we talk a lot about how to make better decisions about money, how to work with your advisor, and really how to create financial confidence. So Simply Why, check it out on all your podcast apps.
Thank you.
All right, till next time. Take care.